So first of all, welcome to all of you that have dialed in. I think you'll find this exciting and enlightening. This is specifically focused for technology-based companies, and I think you'll find that some of the tips that we're going to give you today could over the next couple of years dramatically increase your value. You'll be hearing from two of my colleagues, Bob Graham from WavePoint, and my partner from Preston Willis Group, Glenn Myers. And during the presentation, which will be about 30 minutes roughly, you'll all be muted, but you can type in questions, and if there's something that looks like it's relevant to that particular theme at the moment, I'll jump in and ask them the questions. At the end of the presentation, we'll take mute off. You can ask questions verbally. You'll be given or made available probably sometime tomorrow, white papers, and of course there'll be a copy of this presentation. We'll also be mailing you an online survey. So I'll be cutting in at the end to summarize this. So first of all, Bob, I think you're up first.
Okay, thanks, Bob to Bob.
Yep.
Just by way of introduction, I noticed at least two names here, Karen and Bruce. We've talked in the past. So as you know, WavePoint is a technology M&A firm with clients worldwide. More importantly, the reason we've teamed up with Preston Willis Group is we constantly get requests. I had one this morning about 40 minutes ago. What's the valuation? What can I expect? And often, sadly to say, there hasn't been a lot of prep work done by the seller, the owner, the founder, to maximize his value. So that was one of the key reasons why we're teaming up with PWG to offer this seminar. So we're a full-service worldwide technology M&A firm. We have clients today. We have 4 going to 5 in Australia. We have 6 or 7 in the U.S. Canadians, so we have 3 or 4 Canadians. Have a British client, so we're worldwide. Not so much to tell you we're worldwide. What's important, I think, is where the buyers and sellers typically come from, and overwhelmingly the buyers are, of course, American/British Commonwealth. We do sell side and buy side. We sell patents as well. We actually handle some small, compelling IP sales with little or no people. So most of my day, most of our activity is dealing with expectation of value for the sellers, expectation of value from the buyers, and negotiating. And so again, I'll just give you a perspective on this. Typically, everybody's proud of what they've accomplished, and they should be. Now it's time to sell, to age, whatever, exhaustion. And they typically want a strategic price. You know, they see in the paper that somebody bought somebody for whatever, the Twitter IPO or something. And they want to get the maximum value, and that's absolutely correct, and that's what they should get. The buyers, on the other hand, are actually rewarded for being shrewd buyers and getting a great company at a good price. So on one hand, you've got sellers looking for multiples of revenue. On the other hand, you've got buyers looking for small multiples of EBITDA. And somewhere in the middle is reality. And strategic buyers versus financial buyers is kind of the end game for us when we're representing a client. So the better prepared, again, that you are for selling, working with a high-tech computer model like Preston Willis Group has, because you're in the high-tech sector, the better the end result's going to be. So a little bit of homework for long-term gain. So next slide, please. So the 4 pillars that drive buyers, generally speaking, and I'll give you an example of a call I had yesterday. They're looking for 4 legs to the bar stool. They're looking for good people with subject matter expertise. They almost always want the people to stay on. Often it's an earn-out, so they're going to stay on anyway, but typically they don't want to lose subject matter expertise. They want good clients, good client list, hopefully producing recurring revenue, hopefully worldwide, hopefully, enterprise is obviously preferable to SMB, but there's nothing wrong with SMB. They want good technology. We have buyers who tell us, if it's not cloud, don't even send it to us. That's no longer a trend. It's becoming absolutely mainstream. And good technology with competitive barriers to entry, like better than the other guy, not another EDI system, not another ERP system, but the best ERP system. And good financials. Whether we like it or not, at the end of the day, money talks, and it's a financial transaction to get the good technology, the good clients, and the good people. But you got to have good financials. If you're in a loss position, or no EBITDA, or no growth, or no international expansion, it's going to be tough to get you a fair price. Next slide, please. So I'm just going to give you now some street prices, just to put this in perspective. So I'm assuming here that we're not, we're not talking to you people as the next Twitter or the next Facebook. We're talking about regular, solid, good software companies. So to take just a very simplistic example, and by the way, this doesn't mean the home run price with the strategic buyer. This means a small company, say under $10 million, going to be sold to a company probably under $3 billion, and they're going to pay fair market value plus. And that's our job, if you will. So I start with 1.5 times revenue, assuming you've got some good stuff, like 15% EBITDA, like 20% year-to-year growth, like revenue per employee greater than 150K. Et cetera, et cetera, et cetera. We got about 100 of these views. And there's more on the Preston Willis benchmarking system, as you'll see shortly. So we say you're going to get 1.5 times revenue. Now, we can get you more than 1.5, and we've done that. Now, to get more than 1.5, you've got to have what we call value enhancers. You got to be above those metrics. You've got to be cloud-enabled probably today. You've got to have good competitive differentiators, barriers to entry. You've got to have worldwide sales. And more importantly, and in addition to that, you've got to have very few value detractors. And a value detractor might be your clients are only in the US. In other words, you're not international. Your product is not multilingual. It's not double byte enabled, et cetera, et cetera. So, or you've got flat growth for 3 years or value detractors. But if you have a good company with some value enhancers, very few value detractors, we're talking 1.5 to 2 and perhaps greater. Now, it goes off the chart if it's you're in a brand new sector and people are throwing money just to get into that sector, and you see deals. I heard one the other day went for 7 times revenue. But that's a brand new space, brand new sector. So but this would be for regular sectors, regular companies with some good positive metrics. Okay, and I think I'm going to turn it back to Bob.
Okay, I'll take over actually, Bob. It's Glenn Myers, and we're going to talk about how to increase your valuation by unlocking some of the hidden value in your company, and to get more of those value enhancers on your side and less of the value detractors. So first, a minute about Preston Willis Group. We engage with companies at 4 different stages typically, right from startup through to liquidity. And we have clients we work with where we help them enter new markets, clients entering the US market from offshore Australia, New Zealand, Europe, South Africa. We have clients that are already established in markets, and we help them scale their business by increasing their top line. But what we want to talk about today is the third and fourth line, which is improving your asset value and getting you positioned for liquidity. So we're going to spend a few minutes talking about how we do that and how we could be helpful. The valuations that Bob mentioned, he was talking about a 1.5 times revenue as a starting point, and that's pretty typically how people look at valuing businesses, either a multiple of EBITDA or a multiple of revenue or some combination of those things. We tend to look at value as the ability of your business to dependably produce revenue and profit into the future. And our role is to help you position your business to be able to do that, so that we can look to the M&A companies to go on the high side of the 1.5 times revenue rather than the low side. And there's lots of reasons for improving your value in addition to just selling the business. If you're looking at buying another business, the higher your business is valued, the better you're going to be in relative terms in doing any kind of a deal. If you're doing a merger, you want to make sure you're valued as high as possible. And if you're looking to raise some money either from investment bankers or through the traditional banking channels, you want to make sure that the value of your business is as high as it can be. So we take these tools we have and apply them to companies for many different reasons, not just at the time they're ready to sell. And what we can do is help you determine your value by identifying the triggers that are going to improve the value and creating a plan for you to achieve those results. We do this by starting with a 90-minute assessment that takes a look at trying to determine what the optimum value of your business could be in your sector. We then take a look at what the estimate of the value would be on your business based on this assessment, and create a value gap, which is obviously the number between the optimum value and where you are. And as a result of that, we then create a roadmap to deal with each of these value drivers and determine what we have to do to improve them to increase your valuation and decrease that value gap. The 18 drivers that we look at are split between internal and external drivers. So there's the things that you have control over and the things that are controlled by your market. We take a look at each of these and we drill down first with one question on each of the value drivers. The second phase would be to go a little deeper into each one with about 35 questions, and finally about 140 questions at the very deepest level, and at each one getting a little more granular into these value drivers and determining where the issues are and what we need to do to fix them. So if we look at a typical value driver and a typical first question, it would look something like this. This particular one, we have chosen the barriers to entry category, and this is an example of what the first level question might look like. They're very simple questions at this stage. It's multiple choice, and there's not a lot of debate around where you ought to be. So it doesn't take a lot of time to go through the first phase of this and take a look at what your company might look like based on your positioning on these questions. And for each of the 18, we go through this first level of questioning. What the system is actually doing is it is taking the normalized value for your business sector. One of the things we do when we get started is we determine what business sector you're in, and we're talking to technology companies today. So we would take the normalized value for a technology company, which would be the worst case and best case. As Bob said, there's financial buyers and there's strategic buyers. So based on what the optimum might be, we plot the normal trading range for your category. We then take the answers to the first 18 questions, and using an algorithm, we score the company on an overall score as well as the operational and market driver scores, and plot where you are on the value curve and what the value gap would be. So that's the internal workings. The dashboard that you would be working with would look something like this. This particular example we pulled out as a manufacturing company. The next one I think is a software company in the next slide. But that dashboard looks like this for everyone. So you have in the top left corner, the top left box, you have the overview, which is the industry you've selected, the revenue and profit numbers that you put in, which are the only numbers that you have to put into this system when you get started. It calculates the rating based on your answers to the question. generates the potential value and the value based on your answers and creates a revenue gap. So you can graphically see, as you look at this, what your optimum value would be and what your shortfall is. Down in the center box with the red lines, we also break down by driver exactly where the value is. So each driver then broken down, and there's a numerical value assigned, a monetary value assigned to that, so you know where you can focus to get the best value. And over on the far right bottom, we have red flags, and these are issues that must be addressed if you want to move forward with improving your valuation. You can't get the optimum valuation unless these things are corrected, and we can drill down on those farther in the second two steps of the software to get some insight into how to deal with some of the red flag issues. This is the typical screen that most people that are working with the software like to focus on. It gives you a good overview of what's going on, and every time you achieve a task and make an improvement, this dashboard changes and the value gap decreases. The market drivers are also broken down in more detail for you as to where the shortfall is, both market and operational drivers, so you can get a good look at that detail as well. Again, it's another view of the same dashboard. This one is a professional, scientific, and technical services company, which might be a category that some technology companies might fit into, depending on whether you're software or services company. The next level down, we look at the value gap drivers, and there's a number assigned to each one, so you can see they're ranked from the biggest gain to the smallest gain, so you know where to focus your time and attention. And in addition to that, we rank these by bang for the buck. So it may be that you can take a look at some of these in this example. You know, there's one at the top. It's an $11,000 value gap, which is not big in the scheme of things. Some of the others at 57 or 96,000 are bigger. The difference is that to get $96,000 improvement, you might have to spend a lot of money and put a lot of time in, versus getting the margin advantage or market definition improvements are only about half of the 96,000, but you're going to get them faster and spend less money to get there. So using this kind of a system, we can drill down on each one of these tasks. We can click on the task and you can open up a window, and it gives you some suggestions as to what to do. And if you're working with an advisor like Preston Willis, we also have access to this system, and we can put suggestions in to help you along through the process. As you go through this and you work with your dashboard, you'll notice that across the top we have several buttons to push, icons. We can have a look at overviews. We can look at the value drivers in detail. We can jump around in this system from one thing to the other. You don't have to go through it sequentially, so you can focus on the areas where you're most comfortable first and solicit help from other people to get through some of the more difficult areas. But you can continually move around the system from item to item without going through it sequentially. As I mentioned a minute ago, we also have a window into this so that we can come into the system on a regular basis and work with you on some of these tasks. We can't change any of the information, but we can monitor what's going on. You can communicate with your advisor through the system to get help on specific items as you're working with it. The other thing that we have in a system is a vault, which is essentially looks like a Google Drive facility, where as you complete a task and it's documented, you can load the documentation up into the vault. So when you're finished going through the system, you not only have measured the value gap, identified what the tasks are to improve that value, you've also documented and stored the appropriate documentation to support that. So if you are in a position where you're looking to negotiate a sale or you are in any kind of a due diligence activity, you essentially have created a data room for your M&A advisors. So when they come in and look at the business, everything is documented and it's there, and you can show it to them. So that's a quick overview of the system. Again, as I said, there's 3 levels to it, starting with the first one, which is the 18 questions. The second one is drills down a little deeper, and the third gets into actually accomplishing the tasks, documenting them, and storing the information in the data vault. So if we go to there we go down here. What we would like to suggest to the people that have spent the half hour with us so far is that we would be very happy to work with you for an hour and go through the initial assessment of the 18 value drivers so that you could take a look at see how your company fares against best practices and optimum valuation. And if you're interested in getting any further information on the software and system, we're happy to provide that, give you a full demonstration, and talk about how you can engage with us on some of these issues. So with that, Bob, I'll turn it back to you. Bob?
There. Okay, sorry, I just had to unmute myself. Sorry about that, guys.
Okay.
Thanks, Glenn, and thanks, Bob, for that presentation.
Okay.
I see everyone is unmuted now. Are there any questions from anybody? You can type them in or just start speaking. I'll take that. I guess I'll take that as a no.
I have a question.
Yeah.
Jim
Okay,
here
good.
from
Yep,
Unionware.
Jim.
Hi,
Jim.
I noticed the valuation, the first formula you used was 1.5 times revenue. Is that typical, or is that do you often use the earnings multiple of earnings?
Do you want me to have a cut at that one?
Sure.
It's Jim. Good question. At the end of the day, it's actually everything. I mean, some people will put a bigger negative on the lack of EBITDA. Some people will say, well, this is a startup company. It's only into year 5. I really need this for competitive advantage to beat up on IBM or Google or somebody. And they're going to look more about the technology and the strategic advantage of the technology. So everybody's going to, you know, the beauty's in the eye of the beholder. So we get buyers from all shapes and sizes, shall we say. And depending on what their hot buttons are, obviously that's what we dress up and move forward. So I'll give you an example. We sold a company to OpenText. We got a very good valuation. It wasn't sold on profitability. It was sold on strategic advantage. OpenText bought it for strategic advantage. Their 2 biggest competitors had e-learning companies. They did not.
Right.
So there's an example of where competitive advantage, promise of tomorrow, future is very important to the buyer. Other people will come in and start right at the beginning and offering you a low multiple of EBITDA. We usually don't spend much time with those people, especially if we're dealing with the CFO of a publicly traded company, because we know it's going to be a discounted cash flow. It's probably not going to go anywhere. We're talking to the wrong people. We need to be talking to the people, the president, about how he competes in the marketplace and needs better products. And the big companies, the reason the M&A sector in every sector is so good, strong, is large companies just can't develop fast enough internally to compete in the marketplace. It's always too late, too expensive, over budget, and doesn't have the features of those nimble little competitors. And so that's why in all sectors, the larger, the big sharks eat the smaller sharks, eat the smaller fish. They have to do it to grow. And if they've got shareholders every quarter saying, how's it going, they have to show that they're, how would I say it, growing through aggressive and competitive and insightful acquisitions.
I have another question if no one else does.
Oh, great. Yep.
How do you say I went to you and said, yeah, I'm ready to sell. How would you go about marketing that business? Do you have an existing network of, like, how do you know who to approach, and how do you approach them without, like, I would think that some of them would be potentially my competitors if we're trying to get a strategic deal going. How do you approach them without giving away my willingness to sell, which could be perceived as a weakness?
No, very good question. So, number one, we have a do not contact list, which you give us, and we block them out of our database because our database is massive. It's 21,000 tech companies worldwide. We target your sectors. So, Jim, if you were in, to keep it simple, let's say you were in business intelligence reporting. We have about 1,000 companies in business intelligence supporting. Then we go to the next sector. It might be collaboration. It might be analytics. It might be big data. It might be. We typically, for an average client, hit about 12,000 of the 20, maybe 15,000 of the 21,000. The other thing we don't want to miss out on somebody who, for example, is not in business intelligence today but wants to be in business intelligence tomorrow. And so you're protected. If you look at the teasers on our website, all of our clients are on our website, by the way. They're all coded. You can't even reverse Google the teasers. We've already done that. So you actually can't find out who our clients are. Now, once an NDA is signed that you see first, so the buyer has to sign the NDA first. I've already signed it. We present it to you with what we call interview notes. So I interview them and say, well, why are you interested? Is it strategic advantage? Is it to get their customer list? Is it? And as I mentioned to you, I had a call yesterday, and basically they were going to, it was an ERP company that's my client. They were going to buy the company and basically trash the technology. They only wanted the customer list. Well, that doesn't work. Financially, that'll never work. Why? Because what are you going to do? I mean, you're only buying 3 legs to the stool. And so, they don't go very far. When I interview them, if I don't see good rationale, we don't go to NDA, and hence you never get to see it. But the good ones that have good rationale, you get to countersign the NDA if you wish, and we move forward. So you're protected at 3 levels. Teaser's protected. You have a do not contact list. They sign the NDA before you do.
Got it. Thank you.
Yeah. Good questions, by the way. Anything else? Any? Yep.
No one else is up. This is Bruce Olcott with Compliance Manager. Hi, Bob.
Yep.
Hi, Bruce.
On the initial email that I got from you folks, WavePoint, you had a very interesting factoid on there. It says 80% of private businesses put on the market with less than 50 million in revenue do not sell. So if you're even trying to think, is it worth it, and you have less than 50 million in revenue, is it even worth it to try and think about it? Does it go to those 18 points of judging all of the strengths and weaknesses of the company, that type of SWOT test? Or is there something else? Because you obviously don't want to be wasting your time with the 80% that aren't going to sell. So I'm having trouble pulling these data points together, because I think on one of the slides I saw the number as low as 1 million. So you see what I'm getting at here? I'm having trouble figuring out whether it's even worth it. What can you look at short of those 18 points to decide whether it's value in even looking at it?
So, Bob?
Yep.
Okay, so maybe I'll take that first. First of all,
well, I was going to.
Go on. Yeah.
Go ahead. No, Bob, you go ahead. I think that's your bullet on the slide.
Yeah. Okay. So what I was going to say is that's the whole point of this presentation, is because one of the major not the only, but one of the major factors in producing that stat was that there's a value gap. There's often a value gap between what you think your business is worth and what the market thinks it's worth, and that sometimes is insurmountable. But if you follow this process that we're talking about over a period of time, it could be months, it could be a year or two, you'll end up closing that gap, getting more value out of your company, and it will match what the market thinks of you. So that stat wouldn't apply to you if you followed this process. Bob, over to you.
Yeah, I would only add the following, Bruce, and you and I have talked before. We interview you, we look at your sector, we look at your metrics, we talk. I'll give you an example. If you're another EDI vendor in a space that's absolutely 100% crowded, everybody's discounting because everybody's got EDI. It's basically a customer list acquisition. You would probably not. Would you sell? Of course you'd sell. Would you like the price? You would not like the price. So I mean, you get down to. I think the reason why a number of customers in all sectors don't end up selling is they don't like the price. Now, the reason they don't like the price, there's many reasons, but I would say the reason they don't like the price is they don't have compelling metrics. Now, the only way you're going to get compelling metrics is to work with, say, a PWG here to make sure you understand the metrics in your sector. And what are they? And what are the hot buttons? You know, like I mentioned, cloud enablement. Well, we had a situation where we had a deal tank on us because in the thing was, well, we're going to move from license to cloud. And the buyer did an independent analysis of how many millions it was going to take and said, I'm not going to buy it. It's going to take too long. So to understand the drivers in your sector, in this case software, and benchmark it, which PWG will do for you, and understand where you are on the curve and when's a good time to sell. My attitude is if we sign you up, we're going to sell you. May take a few months or a lot more than a few months, and you may not like the offers because they're going to constantly point out your value detractors. If your value detractors are patched up and taken care of, and you have value enhancers, you're going to find that strategic buyer.
Yeah, that's great. Thank you. You led to my second question, which is how long on average do you end up spending with a candidate, either on the buy or sell side, before you find a deal and make it happen?
I would say the industry average in the software world is pretty close to 11 months. We like to think we can do it in maybe 9 months. Very difficult to do for, quote, an average company with good stuff. It does. I had a $3 billion company take 4 months to do the due diligence with Pricewaterhouse on a very small company. Well, so if you take out the due diligence of selling to a very large public company, you're probably talking 6 to 8 months.
Okay, thanks.
Okay. Anyway, great questions. Thanks for the questions. Anything else, guys? Okay, if there isn't, we'll wrap up. So as I said at the outset, there'll be a white paper available to you. We're going to send you an anonymous survey by email, and the slides will be available to you online. We'll send you a link to get those. And any last words from you, or Glenn, or you, Bob?
Just a quick thank you for attending, and please take us up on our offer. We can send you a link to initiate the software so that you can go through those first 18 questions. You can do it on your own and then talk to us, or you can do it with us on the phone with you so that we can help you. But it'll give you a good sense of your initial valuation relative to your industry sector.
Great. Thank you.
Yep.
Thank you all for attending. That's great. That's it, guys.
Thanks very much.